and portfolio manager at CIBC Wood Gundy. Andrew, always great to see you. Love the jacket, by the way. Thanks for the festive attire. You've made some commentary in some recent notes that you've written for clients that it's very difficult. It's not easy to predict at the end of a particular year where equity markets are going in the year ahead. And you note that there were some prominent forecasters a year ago who were predicting a modest year in stock markets in 2024, and we've had really another record-smashing year on North American equity markets. What is your take on where markets could go in 2025?
Well, thanks, Paul, and great to be here. I think if we look back to last December, Paul, analysts got the inflation story right. In fact, inflation in Canada probably a little bit better than what we thought. They underestimated growth in the U.S., and I think that's one of the key reasons why analysts underestimated the strength that we would see in the stock market. And of course, to your point earlier, Paul, a lot of the strength prior to December really came from the U.S. election results, expectations of lower taxes, deregulation, what have you. I think December, though, Paul, is a little bit of a wake-up call as to what we may expect next year. It's not to say we can't get a third year in a row of strong gains on the markets, but we are going to see a much more volatile market, much more sensitivity to interest rates that do not appear to be falling to levels that we thought earlier in 2024.
The bull case seems to be very frequently anchored on the incoming White House, on Donald Trump, in short, and on expectations of lower regulation on big U.S. corporations, quite likely lower taxes as well. What do you think of that narrative?
Well, the narrative is 100% correct, Paul, in that if all we were talking about today is an environment where taxes are going to go down, where regulations are going to be a little easier on big financial institutions, then we would be probably talking a little bit more confidently about an outlook for U.S. stocks where maybe we do get a double-digit gain yet again. The problem is when we talk about these two positive factors, we kind of whisper the tariff issue and the policy volatility issue in 2025. And I think this is where investors really have to wait and see what is going to happen in January once we have inauguration, what policies are going to be implemented or can be implemented, and how big of an issue is the tariff and trade war story going to be, because that is going to be the trump card, pardon the pun, Paul, to a lot of the positive attitudes that developed after the election.
It sounds like you're expecting a more volatile year. Is that fair?
I think that's fair, Paul. We've said to clients, look, no one knows if the market's going to end up or down. Consensus views, S&P 500, 6,500 by the end of 2025. That would give us about a 9 or 10% gain from today's levels. But we don't know, right? And we don't know the impact of policies are going to have. What we have said to clients, however, is that regardless of whether we're up or down in the markets, we're probably or most likely going to see volatility levels elevated in 2025 relative to 2024. This time last year, Paul, we were talking about volatility levels down close to 12% on the VIX. Very, very calm environment. Now, we're not extremely high right now on the VIX, but I would argue that 2025, we're going to see on average a VIX that is higher than what we saw in 2024.
What sectors of the U.S. equity market do you favor right now?
Well, I think for now we still favor financials, Paul, and we favor tech. I think those two sectors will continue to show momentum. Again, if we get a general market setback, both of those sectors are going to be hurt as well. But I think we have more positives, let's say this, on those two sectors, Paul, than on others. So, for example, if we're looking at the consumer, we saw consumer confidence this week coming in below expectations. We've got longer-term borrowing costs rising again. Those are going to eat into consumption growth in 2025. So we would not be favoring consumer stocks at this point. Energy, it's interesting, Paul. I've been on the show many times. We're quite bullish on energy, and I remain so. I think oil prices can stay elevated in 2025, and that should give some support to the energy patch.
And that plays into the Canadian stock market. What's your view on Canadian stocks? You seem to be saying that you like the setup for Canadian oil and gas producers.
We do, Paul. I think oil and gas should do well in 2025 on the Canadian side. We still like financials. I think provided we continue to see interest rate cuts by the Bank of Canada, lower borrowing costs, that should soften the blow for consumers. But again, the elephant in the room, Paul, as you and I know, is what is going to happen to tariffs. If we have a 25% across the board tariff against Canada, we're going to take all those economic forecasts, we're going to shred them immediately because we're going to see a different economic outcome and therefore a different market outcome. But all things being equal right now, we would still like the financials, we would still like energy. And to your earlier point prior, Paul, when we look at some of the telecom stocks, massively beaten up in 2024, we think that now we're starting to look at value in that sector. Dividends will be questionable, or investors should be looking at dividend quality. But I think the sector, again, probably now provides a little bit of value into 2025.
One of the big negatives for the telcos has been an extremely competitive pricing in the wireless market, where they've been forced or encouraged to cut their prices to compete largely with Freedom Mobile, which is which seems to be a strong fourth player in the wireless market, owned by Quebecor. I've seen analysts say that they think that competitive pressure is likely to be over, or at least to pause in 2025. Do you see a more constructive pricing environment for the telcos?
Yeah, we do, Paul. And I think a lot of that is largely priced into the stocks. In fact, you could argue that perhaps disproportionately priced into the valuations of some of those players in the sector. It's competition, was I think inevitable. Analysts have been talking about this for years. We've now seen the impact on price valuations. But I think right now, that is largely baked into the pie. I mean, how much more competitive does this space become? I would say right now we've probably seen the worst for the sector behind us. And that means that if we're more constructive on pricing, as long as demand continues to grow, which we believe it should, then that gives us a better foundation, I think, for those stocks in 2025.
Andrew, thanks a lot and happy holidays. Andrew Pyle, Senior Investment Advisor.